Welcome back to Investing Talk Podcast. Today, we're tackling a question that I know many of you might be asking. Is Applied Digital a good time to buy now? We've gathered some really comprehensive sources to help us unpack this one, looking at, everything from their financial health right through to market sentiment. Our mission today is really to give you the clearest possible picture so you can understand all the nuances of this potential opportunity. Before we jump in, though, just a quick note to you, our incredible listeners. If you're finding value in these discussions, please do consider subscribing, liking, maybe leaving a comment. It genuinely helps us bring more of these insights to you. And if you'd like to support us further, you can always buy us a coffee. The link's usually somewhere below. Also, if there's a specific company you'd like us to look into next, please, leave a comment below. We love hearing your suggestions. All right, let's explore Applied Digital. They operate in a truly captivating part of the tech world, wouldn't you say?
Absolutely. What's truly compelling about Applied Digital is their core business. They design and manage high-performance computing, or HPC, and AI data center solutions.
Right.
And they're serving both the demanding world of cryptocurrency mining operations and the rapidly expanding need for GPU computing customers.
Oh, okay.
So they sit right at the nexus of some of the most dynamic technological shifts we're seeing today. They're essentially building the crucial infrastructure for these fast-moving industries.
So we're talking about a company building the backbone for AI and crypto. That sounds like a powerful narrative, a really exciting story. But beneath that excitement, what do the raw numbers really tell us? About their financial health, their ability to actually deliver on that promise.
Yeah, that's where it gets, well, interesting is one word for it.
Right.
When we dissect their fundamental analysis, Applied Digital reported trailing 12-month revenue of $144.19 million in 2025.
Okay.
Now, this did show some growth, a modest 5.54% year over year from their prior year's $136.62 million.
Right.
However, and this is the pivotal point for any potential investor, the company remains profoundly unprofitable.
Uh-oh.
They posted a staggering net loss of $233.68 million.
Wow.
And what's particularly striking is that this loss actually widened by 56.5% compared to the prior year.
Oof. So it's getting worse, not better on the bottom line.
For now, yes.
Yeah.
Their most recent quarterly EPS was minus 3 cents. Now, that did manage to beat analyst estimates slightly.
Okay, a small positive, maybe.
But it implies losses are very much expected to persist. The forecast for the next quarter is actually a loss of 14 cents per share. There's really no clear consensus among analysts for a swift return to profitability, and their future earnings look quite volatile, mostly because of the aggressive investment they're making into infrastructure and their high operating expenses.
That net loss you just mentioned, over $230 million against roughly $144 million in revenue, that's a significant disparity. What does that kind of unprofitability signal about their long-term financial stability, their ability to keep going without constantly seeking outside cash?
It immediately raises critical questions, questions about their operating efficiency and their overall sustainability, really. While our sources didn't detail specific debt and cash flow figures in the latest reports, that aggressive capital spending on infrastructure, combined with this persistent negative net income, it strongly suggests they're heavily reliant on external financing.
Right. Debt or selling more stock?
Probably both, but likely issuing more equity seems probable. For you, the investor, this means being particularly conscious about potential dilution.
Where new shares make existing ones worth less.
Exactly. And also the broader liquidity risks. Until they can firmly establish operational break-even and start generating positive cash flow from their own business, it's that classic growth company challenge. They need capital to grow, but that growth isn't yet paying for itself.
So funding is definitely a key concern. Given that, how do they measure up in their competitive landscape? Are they kind of forging their own path, or are they bumping up against some major players?
Oh, they are far from alone. The sector they operate in, high-performance computing, AI data centers, it's fiercely competitive.
I bet.
And demand for their services is intrinsically linked to those broader trends in AI, machine learning, and, of course, the crypto markets, which can be incredibly volatile.
Yeah, crypto especially.
Right. This inherent demand volatility makes their business quite susceptible to rapid shifts. Now, Applied Digital's market cap, it sits at a substantial $3.87 billion.
That's pretty big for a company losing that much money.
It implies incredibly high expectations for future growth are already baked in by the market. But carving out lasting competitive advantages against larger, often much better capitalized players, That remains a very real and constant challenge for them.
They're up against giants, potentially.
Established tech titans with immense resources, yeah.
Considering what we've just discussed, the financial picture, the fierce competition, it really begs the question, how is the market actually valuing Applied Digital right now? What does that valuation tell us about investor expectations, maybe despite those big losses?
Well, from a valuation perspective, because of the negative earnings, the traditional price to earnings or PE ratio, it's not even calculable.
Right, can't divide by zero or a negative number.
Exactly, which is often a red flag in itself. But their price to sales ratio, that stands at approximately 26.8 times.
26.8.
Yeah. To put that in perspective, that is far, far above typical infrastructure or even general tech sector averages.
Wow.
That single number tells you that extremely high revenue growth expectations are already entirely priced into the stock. And while the price-to-book ratio wasn't explicitly reported in our sources, it's highly probable that it's also elevated, given recent equity raises and those ongoing losses.
So it's all about the future.
These elevated ratios collectively signal that Applied Digital isn't being valued on what it is today, but almost entirely on what it might become tomorrow. It's a high-wire act. Any stumble in growth could mean a significant fall.
Okay, so a lot of future potential is definitely priced in, setting a very high bar. How has the stock price itself been behaving? What's the technical analysis showing us about recent movements and key levels?
Currently, the stock is trading around $14.79. Now, this is very close to its 52-week high of $15.42.
Oh, really? Near the top of its range, then?
Exactly. And dramatically above its 52-week low of $3.01.
Wow, quite a ride over the past year.
It absolutely reflects substantial volatility in its trading. For traders looking at the charts, major support seems likely in the $12 to $13 range. That's where it's found buyers before.
Okay.
Conversely, resistance, where selling pressure tends to emerge, appears to be between $15 and $16,
Yeah.
right near where it is now. It's also worth noting, intraday swings are quite broad. The price can move a lot within a single day. Lots of active trading, high speculation.
You mentioned substantial volatility. What about more specific technical indicators, like momentum signals? Anything standing out for traders trying to maybe ride these kinds of waves?
Yeah, this raises an important point, especially for momentum traders. The stock's beta, that's the measure of its volatility relative to the broader market.
Right.
It's exceptionally high at 6.0.
6.
Yeah. This figure unequivocally confirms its major volatility. A beta of 6 means, roughly, if the market moves 1%, Applied Digital tends to move 6% in the same direction.
So definitely not for the faint of heart.
Not at all. It's far more like a roller coaster ride than a steady climb for anyone holding it day to day.
Yeah.
Now, while upward momentum has been strong through 2025, suggesting a bullish trend, there might be signals that it's becoming overbought.
Meaning it's gone up too fast, maybe due for a pullback?
Potentially, yes. Although specific RSI, that's Relative Strength Index, and MACD moving average divergence levels weren't in our sources. The recent price action, being so close to that 52-week high, strongly suggests caution for momentum traders. They need to be really aware of the increased risk of a reversal or correction here.
So caution is definitely the watchword for technical traders. Beyond the raw numbers and charts, what's the general sentiment surrounding Applied Digital? What are the analysts saying? What's the buzz on social media? Is everyone just caught up in the AI hype?
Well, it's a bit of a nuanced picture, but generally leaning positive, I'd say. 12 analysts rate Applied Digital as a strong buy.
12. That sounds pretty good.
It certainly sounds robust on the surface. However, their average price target is $13.83.
Wait, $13.83? But it's trading near $15 now.
Precisely. That average target is actually a slight discount to the current trading price. It implies rather limited immediate upside from where the stock is right now.
Huh. So the strong buy ratings don't quite match the average target.
It's a bit contradictory, isn't it? An individual analyst targets span a very wide range, from a cautious $7 on the low end to a much more optimistic $20 on the high end.
That's a huge range, shows a lot of disagreement.
It really highlights the significant disparity in professional expectations. Some sources, like TradingView, did report a higher average target, around $17.22, but overall it's clear that expectations are mixed. In terms of insider activity, our sources didn't mention any notable patterns of buying or selling from executives, so neutral there.
Okay.
Social media sentiment, though, is generally quite positive. mostly fueled by that broader excitement over AI and HPC tailwinds.
This.
But critically, this optimism appears to be already well reflected in both the analyst recommendations and, most importantly, the current share price.
So the good news might already be baked in, basically. You're not getting in early on that sentiment.
That seemed to be the case. You're likely buying into established enthusiasm.
Right. So what are the key events or developments coming up? In the short term, that could directly impact the stock's performance either way.
Okay, short term, the next earnings release is a big one. That's set for July 30, 2025. That's a significant catalyst.
Always is for volatile stocks.
Definitely. There's always potential for upside surprises, maybe in revenue, maybe slight margin improvement, which could give the stock a boost. Or, of course, a miss could hurt it. Beyond earnings, any announcements of new data center contracts or especially new AI client contracts, those can move the stock significantly.
Proof of execution.
Exactly. It demonstrates concrete business growth, validates their strategy. And lastly, just broader sector moves in AI or crypto-related stocks often trigger volatility for companies like Applied Digital, given their direct exposure.
So keep an eye on the whole neighborhood, not just this one house.
Absolutely. They tend to amplify those wider market trends.
And looking further out, maybe beyond the next quarter or two, what are the long-term drivers or fundamental shifts we should be aware of? Things that could truly change their trajectory, make or break them.
Over the long term, their ability to truly scale and diversify their hosting business for AI and HPC applications will be absolutely crucial.
Meaning getting bigger clients, more stable ones.
Yes, attracting and retaining large, stable enterprise clients, maybe moving beyond just the volatile crypto space. Diversification into more stable, maybe enterprise-facing data center services. That could offer more predictable, recurring revenue streams. That would be a very positive development for their long-term viability.
Makes sense. Less reliance on the crypto roller coaster.
Precisely. And finally, broader shifts in the regulatory landscape or the energy landscape. Those could significantly affect their business model.
How so?
Well, think about regulations impacting energy-intensive crypto mining, or rules around high-density compute solutions, or just dramatic shifts in energy prices. That could fundamentally hit their bottom line, their hosting costs, their competitiveness.
Okay, given everything we've discussed, the financials, the market position, the sentiment, the short and long-term stuff, what are the main risks? Let's boil it down. What should an investor truly keep front of mind with Applied Digital?
Yeah, this is crucial from a stock-specific perspective. Number one, the ongoing substantial losses and that high cash burn rate with no immediate or clear path to profitability. That's paramount.
Got it. Risk one, profitability.
Risk two, their dependence on volatile sectors like crypto and GPU demand. These markets can swing wildly, unpredictably.
Risk two, sector volatility.
Risk three, the ever-present risk of dilution, if they need to keep raising capital by issuing more shares to cover losses or fund growth.
Risk three, dilution. Okay.
Then, looking broader, market and sector risks. Macro headwinds like interest rate hikes or just a general tech sector sell-off could really pressure high multiple growth names like this one.
Risk four, market conditions.
Risk five, competition from larger established AI and data center operators. They have deeper pockets, existing clients, maybe better infrastructure. It's a constant battle.
Risk five, competition.
And finally, risk six, energy market volatility could heavily impact their hosting costs, erode margins, make them less competitive.
Risk six, energy costs. So quite a list.
It is. The core takeaway is really that double-edged sword. Immense growth potential, yes, fueled by exciting future trends, but also a business model, very dependent on raising cash and highly susceptible to market swings.
Okay, so after dissecting all of that data, let's bring it back to the original question. For someone asking, is Applied Digital a good time to buy now? What's the distilled message? Let's connect those dots.
Okay, connecting the threads. The overall rating from our sources is a 5.5 out of 10.
Middle of the road, maybe slightly leaning positive?
Sort of. Applied Digital certainly possesses strong growth potential in that critical HPC and AI infrastructure space. That's reflected in the generally bullish analyst ratings and its recent impressive price action. But the extreme valuation multiples, those ongoing large losses, the significant cash flow concerns, and that inherent sector volatility, they fundamentally make this a high-risk, high-reward proposition. It appears far more appropriate for short-term, momentum-oriented traders, people comfortable with big swings, active management.
Not really a buy and hold for stability seekers?
Probably not. Not for investors primarily seeking stability and proven profitability. And what's particularly noteworthy, again, is that most near-term analyst price targets, averaging around $13.83, actually imply some potential downside from current levels.
So even the bulls aren't projecting much immediate upside on average.
Exactly. Suggests limited room to run right now, based on average expectations.
Okay, so for those who might be considering trading this stock rather than holding it long term, what's the suggested tactical approach based on these insights? What are the practical levels they should watch?
Given this high-risk, high-reward profile, the investment horizon favored here is explicitly short-term trading because of the volatility and the business uncertainty.
Makes sense. So entry points.
For trading, a suggested entry on pullbacks might be around the $13 to $13.50 level, looking for the stock to retest that recent support area where buyers stepped in before.
Okay, buying on dips near support. What about protecting the downside?
A stop loss could be strategically set, perhaps between $11.50 and $12. Place it decisively below those recent support areas to limit potential losses if the trade turns against you.
Right, managing the risk and profit targets.
For taking profit, maybe $17, $18 could be a suitable target area that's approaching potential resistance. Ideally, you'd want to hit that before significant resistance kicks in, or maybe trail the stop loss up if there's strong news-driven momentum.
What a compelling yet really complex situation with Applied Digital. It's clearly a company with, yes, immense potential in a red-hot sector, but also carrying significant risks and a valuation that already prices in an extraordinary amount of future success. For you, the listener, it's really about understanding that delicate balance, isn't it, between those high-growth expectations and the very real financial challenges and market volatility. As you consider all this information, maybe think about your own risk tolerance. Here's a provocative thought to leave you with. How much is future potential truly worth when it comes attached to current, significant unprofitability? And how long can a company sustain those kinds of losses before it genuinely impacts its long-term viability, regardless of how much market excitement or how compelling the story is? Something to mull over as you continue to explore the companies shaping the future of computing